Hello and a warm welcome to the webinar on designing a powerful and customer-centric debt collection process. Thank you for joining us this morning, this afternoon, wherever you are joining us from in whichever part of the globe. I'm so excited to have our panel members today. Let me start with a quick introduction. Firstly, we have Ahmed Al-Sheikh, CIO at Jordan Islamic Bank. Ahmed is an accomplished tech leader with close to 2 decades of experience in the field of IT. He currently, as I said, serves as the Chief Information Officer at Jordan Islamic Bank. Jordan Islamic Bank is a member of Al Barakah Group, which is a prominent Islamic financial group with banking subsidiaries in 15 countries. Ahmed's experience spans across multiple industries in the Middle East, right from the manufacturing conglomerates such as the Astral Industrial Group, Veolia, Abu Dhabi Gas Development Company. And so he's actually bringing a very unique perspective to what customer journeys in banking mean. So welcome, Ahmed.
Thank you so much.
Next, we have Karen Savage, COO at Azzurro Associates. In her 25-year litigation career, she has held major positions as an equity partner at 2 national law firms, most recently as Shoesmith, where she led the commercial recoveries team. Karen has a proven track record in founding, managing, and leading high-performing commercial collections teams. She's worked with lenders, credit insurance companies, and very large blue chip companies in setting up their collection strategies, and also dealing with high value, complex legal disputes. And I think she will tell you that how when you manage the customer journeys well, probably that's the best way to avoid getting into those very complex legal disputes. Welcome, Karen.
Thank you. Good morning, everyone.
Next, we have Tamás Erni, who is the CEO at Loxon Solutions. He's been a career Loxonite, if I can call it, starting in 2001 at Loxon, and he's built the lending and risk management practice ground up at Loxon. He's responsible also for building the business consulting team, and he manages several projects when it comes to transforming a bank's lending operations and the risk management procedures. Is one of the people you can always turn to when you have a topic of lending and collection. So welcome, Tamás.
Thank you. Thanks very much. Hi, everybody. Welcome here.
Finally, we have Adam Kocsis, who is a partner also from Loxon. He's again participated in multiple projects when it comes to project implementations for lending solutions and right across Europe. Basel II and Basel II preparations and making sure companies are adhering to the Basel II norms is one of his specialties, and he manages the professional services function at Loxon. Hi, Adam. And today we are going to pick their brain on something very interesting. How do you design a powerful and a customer-centric debt collection process? Look, we all know these are extremely challenging times for the global economies. Prolonged conflict, we have rising inflation, the risks of COVID-19 bubbling up again always make the news somehow. You had supply chain disruptions and all staring into a looming economic recession, right? And this has a very significant influence on the whole liquidity-rich period that the world has enjoyed. And that has a direct impact on lending, and more specifically on collections. Look, lenders have a financial obligation to their stakeholders, but at the same time, they cannot distance themselves from the socioeconomic aspects of collections. Regulations do require appropriate care to be taken when you're dealing with people when it comes to debt collections. But beyond that, right, even from an economic standpoint, a person may be going through challenging times now, but from a lifetime value point of view, the person could be very important going in the future. So customer experience right across all types of customers, right, all types of cohorts and segments becomes very important. And hyper-personalizing these collection strategies becomes, again, very important, and that could be the answer. And within that, technology could be the answer to do all of this in a very cost-effective manner, right? So by the end of today's webinar, we hope to know some of the steps that lenders can take, which can help streamline the customer journeys throughout the debt collection process. So with that, let me get started. Let me, first put up a poll question and see what the audience feels about some of the issues within when it comes to collection. So the question is, what is the most important aspect to keep in mind when building a debt collection platform? Is it improving the customer experience? Is it the cost factor, which is reducing operational cost? Is it about compliance, enhancing compliance? Or is it about this data security? So again, understanding what is the most important aspect is what we are really trying to understand when it comes to a debt collections platform. Let's give the audience 15 more seconds to go through the question and respond. I can see that the customer experience is coming right on top so far, followed by the operational costs. So I'm going to end the poll in the next count of 3, 1, 2, and 3, last chance. All right, so I'm going to share the results. It's very interesting. And again, shows that we are talking about the right things. This is the right topic to be talking about. Improving customer experience indeed comes out as the most important aspect when it comes to debt collections platform. I'm going to first call up Adam, who's going to take us through a quick presentation about debt collections, what the debt collection trends are, what are the most important things in the debt collection space today. Adam, over to you.
Okay, great. Thank you, Nikhil. Hello, everyone. Second. Okay. So we're going to address today how financial institutions can enhance their collection effectiveness, whether there are certain design patterns that could be followed to achieve more client-centric collection. Before we get more into the details, let me share with you a few relevant information about Loxon Solutions. Loxon is a business solutions provider, bringing business software solutions for the financial services community, covering the end-to-end lending, collection, and risk management lifecycle. This market niche is our core competence. We do not cover any other industries or business domains. During the past 20 years, we have become an international vendor with more than 80 customers on 4 continents. As you can see, our major reference customers for collections include ING Group, which is one of the 25 largest banking groups on earth, where our collection system is a group standard, or Home Credit International, one of the 5 largest consumer finance providers on earth, where our collection system is also a group standard. During the past 20 years, we could see significant shifts how debt collection is managed in financial institutions. When we started our first collection project in 2003, back then, automation of manual tasks was the main expectation for a collection recovery system. Following 2008-2009, the focus started to shift towards achieving higher recoveries on delinquent portfolios mostly via better tuned, transparent collection strategies. And during the last couple of years, the requirements for a collection system have profoundly changed, as you could also see based on the questionnaire results. Now the primary expectation is that collection should be part of a positive client journey. Clients should have a collaborative, fair treatment experience, also in case they fall behind in payments. How can we achieve such improved client experience by enhancing the effectiveness of our collection? This is the question I will try to answer in the upcoming slides. Here I would like to highlight 3 examples how financial institutions can enhance their collection practices, thus achieving better effectiveness and increased customer centricity. After describing these examples, on the following slides, I will go through the necessary steps and prerequisites which should be considered when designing such client-centric collection solution. Before a client would get into financial difficulties, the bank can apply early warning solution that enables to proactively get in contact with the debtor and discuss alternative personalized solutions like restructuring of payments in sync with the client's ability to pay. Banking mobile applications can provide huge amount of useful information for detecting early warning signals. Beyond the regular triggers, banks can get a lot of useful behavior information as well. As you can see, another area is hyper-personalization. Based on the specific situation of the client, the bank can offer personalized repayment plans, which are customized to the client's current and future expected affordability measures. Furthermore, by using mobile application, the client might be addressed with hyper-personalized payment promises or restructuring offers via push messages. Certain client segments, particularly the younger generations, can be more responsive to such initiatives supported with chat functionality with bank experts instead of the regular phone calls. And the third area of our examples here is the setting of dynamic engagement plans, which can be used for AI-powered collection strategies for creating personalized action plans, where the communication channel selection, frequency, and style of communication can all be optimized for the given client. This way, we would spend our allocated collection budget in a smarter way, achieving higher recovery numbers. You probably noticed that the examples on the previous slide all require large amounts of data. Beyond the internally available data, the role of externally available data is more and more important. We want to have an architecture that natively supports integration to the evolving financial ecosystem. Composable banking can help this problem and contribute to the success of our collection strategies. Composable banking is built on 3 main pillars. First pillar addresses the need for better actionable data. There's a tendency to move from monolith systems to microservice-based API-driven architecture, which is cloud-native, thus making it easy to access the surrounding financial ecosystem and the provided open API-based services. This way, it is possible to access external services or data sources on a need-to-access basis without huge unnecessary upfront infrastructure investments. The second pillar is that the collection system should be based on separate, flexible business models that can be mixed to find the optimal solution. And the third pillar is the agile iterative approach that ensures quick reaction to market changes, which we can experience more and more. So let me address each of these points separately on the following slides. Collection activity is based on data originating from numerous data sources, both internal and external. The value date of data, accuracy of data, or the reliability of data, these all can be different. This is why data governance and data lineage play a vital enabler role before we can even start talking about time-managed AI or start utilizing our data potentially with AI AI support for predictive or potentially even prescriptive analytics. I would like to point out that there are two main approaches related to data collection methodology. The first one encourages to collect all available data into a data lake, saying that data is the new oil. I'm sure many of you have heard this by now. However, soon we can realize that even though data indeed is valuable, without proper data governance, the associated costs will be very high, and we will not necessarily be able to justify its recovery in all cases. The other, more structured approach is where we start with the question, what is the problem we would like to solve? What business benefits eventually we would like to achieve? And only after setting up the business objectives, we start transforming it into an outcome-based technical solution by the collaborative effort of business analysts, data scientists, and developers, thus making sure that we will not just have large amount of data without clearly defined purpose, but we will have actionable data that can contribute to real business benefits of the company. In order to achieve the defined business goal, we may realize that not all data is available in-house. The issue can be addressed by cloud-native API-driven microservice-based architecture. This way, our solution can flexibly incorporate externally shared data and use it for our AI algorithms. A typical example here can be using client transaction data at other banks via account information service providers. Furthermore, we should also have separate flexible business modules that can be mixed to find the optimal solution. And finally, no-code configurability of these used business modules, data models, workflows, and screens can support satisfying the sudden required changes I mentioned before. These changes can originate from competition, regulators, or the changing market conditions. And as the third pillar, let's look at the below implementation case and use this as an example how agile iterative approach might help implementing an AI-based collection system. In this example, our client wanted to have AI support for data-driven collection decisions. They had banking and checking data, transactions data, CRM, lending and scoring data available and ready to use for collection purposes already at the start. These data sources could serve relevant data for the new collection solution. So we built on this data for the first iteration phase of the project. We all agreed that delivering the results in iterations instead of big bang approach is the preferred way. Then, after finishing the first iteration, we started to collect a whole new set of information, such as collection history, payment behavior, self-disclosed information, communication history, and even information from the self-service mobile application. By adding these sources, we could further fine-tune our collection strategies, improving both on the recovery numbers and the experienced client journey. After each of these iterations, we have more and more outcomes, and after the evaluation of these outcomes, the content of the planned upcoming iterations might also change. And finally, here we can see a brief summary of the 3 business problem areas I mentioned earlier, covering early warning detection, affordability assessment, and dynamic engagement plans. On the data side, on the left, I would like to highlight the rapidly growing role of open banking data. This can highly increase the available data used for AI algorithms, since we can rely on much more data about our clients than available in our internal core systems. Also important to note the role of behavior variables. During the collection phase, we might have numerous interactions with the client. We have access to a lot of behavior pattern that we could utilize. For example, we can have data series about keeping or breaking promised payment plans. Particularly, if we offer mobile application to our clients, it can greatly enhance the available behavior information. On the right-hand side, we can also see the separate flexible business models that can be used to support these business problems. For example, we can use a module that can help in detection of vulnerabilities or help to adjust the strategy for suitable treatment. Also, we can help the more effective communication of our operations by using sentiment analysis and smart scripting tools. We can provide modules to support the self-service of the digital assessment, which can tremendously shorten the time for credit applications, particularly if you combine it with the previously mentioned available open banking data. Or for the dynamic engagement plans, we can apply business models that support optimization of channel selection, contact timing, or personalization of message templates. I hope these examples could help you to have a better picture on how to design customer-centric debt collection. And having that said, now I'm giving the word back to Nikhil for moderating our panel discussion where we could dive deeper to these and maybe similar topics. Thank you for your attention.
Thank you. Thank you so much, Adam. I think you gave some really interesting pointers for us to follow. We, in fact, do have a Q&A for you, which we'll probably take towards the end of the webinar. But I would like you to stay on so that if there are any questions that you would want to answer towards the end, you could answer them. So let me dive into picking the brain, as I said earlier, picking the brain of my panelists here. And let me take a step back before jumping straight into the actual collections and customer experience. Let me take a step back and bring you in, Ahmed. What are the most important factors that are really changing the whole lending landscape at the moment, right? And maybe be it globally or specifically within the Middle East.
First thing first, good morning, everyone, and thank you so much for having me. This is a very wide question, but I will try, or even I promise I won't take too much out of your time. But in summary, there are economic factors and technological factors. And I just mentioned economic factors because it is sensitive to all the other factors like environmental, the health, political, wars. The most important economic factor we are facing today is the inflation rate and the high interest rates forced by the central banks to fight back the increasing cost of living. High interest rates may fix the inflation issue, but will definitely create serious unemployment issue, which means fewer new loans due to the high interest rate and more non-performing debts due to the high unemployment rate. But on the other hand, COVID-19 pandemic you mentioned earlier, and I don't need to remind you of the waves of economic shocks it had made on the economy in general, and on the collection process in particular, where customers lost their jobs, organizations shut down, and most having difficulties paying back their loans. What I want to highlight here is that some sectors like logistics managed to survive and boom with home deliveries and online shopping. Video conferencing sector became a lead industry. Zoom was a newly public technology company in 2019 with 10 million daily meeting participants on average. Today, they have 350 million daily on average, competing with the largest technology companies in terms of revenue in just 3 or 4 years. Also, we can see some companies like Amazon, Google, Microsoft laying off thousands of employees in 2022 and 2023. People they have hired during the pandemic simply not needed anymore after returning back to the pre-pandemic level, and the future is less certain. If we take the main components of the collection process, let's start with the financial regulators. We can see their openness is more widely seen with policies, sandboxes supporting innovation, such as digital customer onboarding. In Jordan, for example, we In 2 years, we have seen the central bank coming with digital customer onboarding policy, like blockchain policy, digital banking policy, and definitely the digital lending process is part of all that. Many fintech newcomers entered the lending market, forced some banks to partner with fintech companies or to even start their own digital transformation journey to build the lending process themselves. Customers are actively becoming more and more digital, demanding more digital services. World's largest money market funds today, like JP Morgan or Alibaba, claims that 50% of their transactions are outside the working hours, digital. In Jordan Islamic Bank, digital channels are responsible for over 70% of our transactions. Actually, last month was 83%. Let me talk about the technological factors now. And I believe, like my colleague, Mr. Adam, was talking about, it's all about data. Data are the sources of facts and statistics that can make us take the right decision at the right time. There are various sources of data around us. Internal data sources for the bank, such as the bank ATM transactions, branch transactions, point of sale transactions. But we have also country and regional based data, such as the one in Jordan, provided by Jordan Credit Bureau, that provides the detailed information about the credit transactions related to individuals and companies. We have also external data sources that I love to call online data, collected from within the internet through our usage of our mobiles, smart watches, smart cars, homes, IP cameras, Visa cards, our social media activities, and from other retailers such as Amazon, Uber, Booking.com, and even our movements through GPS is saved on the internet. With this large set of data that's called big data, combined with artificial intelligence tools that we have and the machine learning, the deep learning, companies in the financial sectors can create substantial value for their customers and for themselves. Google made the car drive by itself using the big data. Why can't we predict our customers' behavior with that data? The best live example of this is Visa, decreasing the average time to detect the card fraud from 1 month to just 13 days. Walmart reduced the time it takes from identifying an issue to solve it in a store from 3 weeks, I remember, to roughly 20 minutes.
Data.
There are many other advantages in technologies, such as biometric technology, face recognition, Internet of Things, blockchain. I have no time to talk about all of these, but they have and they will play a critical part, a crucial part in the digital banking landscape, including lending process. Thank you.
Interesting. So, Ahmed, very clearly you touched upon the economic difficulties, the regulatory support that companies are getting, and of course, data and technology. And you took some really interesting examples, from a retail customer side. I wanted to also, maybe Karen, and I'm going to bring you in and just check with you, what are the trends that you're seeing from a corporate customer standpoint? Of course, there are economic difficulties, but there are also these specific challenges when it comes to the lending space at this point of time. That's really changing from a corporate segment.
Thank you. So I have some experience in this because Azzurro's core business is buying debt from lenders. We're an asset management company and an investment business. So at our core, we have millions of points of data on customers that we have acquired, and we use that to inform the strategies that we deploy for collection. As part of what we do, we're constantly in discussions with the lenders that we buy from. So we're quite close to the underwriting policies and the changes that may be going on in that business. So I guess to answer your question specifically in terms of the economic environment as we see it at the moment, a lot of our lenders are saying that it's quite a benign environment. So that from a lending standpoint, there is not they're looking very closely at the underwriting processes that they have in place. They're not seeing on the other side of things a degradation in payment plans, and that actually settlements aren't slowing down, and they're not seeing significant defaults yet either. Now, we work mainly with fintechs rather than the kind of the retail banks, and I'd agree with my kind of fellow panelists that data is the most important point here, and also flexibility in the collections process. But I think what we're seeing is that a lot of the SMEs customers, so business customers rather than consumer customers, are starting to see their cash reserves depleting. So this is what the lenders are telling us they're seeing. So there's been a lot of support from various governments during the pandemic to ease cash flow, and that is potentially coming to an end. So this year will be a very interesting, I guess, development with the social economic factors that we're seeing and how that will affect collectability of accounts. And I think it's important to note that it's a very different position with consumer customers to business customers. So the recovery of consumer debt versus business debt, and the strategies and the segmentation that you would deploy in that collection process is key. And as Adam said, and I can see from the Loxon presentation, the flexibility in design of collection systems is absolutely key, because one size does not fit all when you're dealing with a consumer versus an SME customer.
Absolutely. I think, a really interesting point that you bring up, that while the cracks may not be visible yet, but the cash reserves are depleting, and it just, maybe, a leading indicator of the stress in the system. Tamás, I know we covered a lot from the economic standpoint. Anything, maybe one or 2 points, maybe coming from European experience that stand out for you when it comes to, what are the, economic stress points at the moment?
Well, what we see, what we expect, and I think what many or even most of us expect, is now inflation is soaring. Interest rates are rising. And so this year, like the end of last year, is basically a completely different era than what everybody got used to in the last decade. Because in the last decade, everybody got used to cheap lending, very low interest rates, a lot of money circulating all around the earth. This meant cheap funding for basically everything. And now, quite abruptly, this era is over. But in people's minds, it is not yet fully over. And many people, consumers as well as businesses, they have large volumes of loans that are still reasonably cheap because they got these loans before it all started. They have some fixed interest period where the real impact is not felt yet. So what we expect is that now, this year, everybody will gradually feel that the lending conditions are now much tighter than before. The cost of serving or existing loans and new loans is incomparably higher than it used to be. Inflation is up. It means that in general, the cost of living is higher. So this will create very strong economic conditions for many of us. This will lead to a rethinking of how lenders approach collections, how they approach collections from the perspective that they still will want to keep most of the customers. And on the other hand, they want to secure a reasonably healthy existing portfolio. So this will mean restructuring of how we see collections now, putting the vision of the collection department to a different angle with competing goals, keeping the customers, but still keeping an as healthy portfolio as possible. And this will be the challenge in the next at least 1-2 years, in our view. And what the banks will need for this, and here we go back to flexibility, they need to find a proper balance. They need to investigate, they need to experiment, and they need to find the best ways how to keep collections a part of the positive customer journey and have reasonable agreements with the customers how to serve the loans. So this will be the challenge, in our view, that is coming now.
Interesting. I think you touched upon, my next question in terms of, yes, it's going to be a case of, being very sensitive towards, how do you approach and how do you communicate with the customers and finding that right balance. Karen, I'm going to, ask you as to how do you go about doing this, right? Because, you would have to create, different segments, if you will, right from, how do you communicate? What's the tone of communication, perhaps? What kind of restructuring terms and conditions you may, you may offer? All of that will be highly dependent on the kind of segmentation that you do, and it just, what are the different things that you keep in mind when you do the segmentation in the whole, in the whole, both from a corporate and a retail customer point of view?
Sure, yeah. So Adam very succinctly in his presentation mentioned the importance of the data and the different data sources that are available to a lender or a collections business. I think it's really important that that is centralized in the way that the Loxon system obviously does deliver that. It needs to be centralized and accessible to be able to utilize it to form the best strategies and the best segmentation. We're lucky because when we buy debt from lenders, we buy all of that information. And so we have it in one central place. What we then do is we overlay that with the credit bureau information and other kind of data points around customers' ability to pay. And that helps us to price the books we buy. And we then use that in a way of machine learning and a data scientist approach to predict how customers will behave. And that informs the next book that we buy. We look at a similar book of debt, it may be a motor finance book that we bought, and we build models around that and predict what the customer payment behavior will be. But what we do in terms of segmentation is to use that underlying credit data, and we want to look at different types of customers and how they potentially will behave. So the kind of segmentation that we look at is basic things like the age, the debt balance, the type of debt. Is it a mortgage debt? Is it a car loan? Is it a credit card debt? We will look at things like the customer's own personal circumstances. Are they homeowners? We will then look at the equity position on any home that they own. And that will enable us to score that customer and to see what their credit profile is. So a customer that has a home ownership with no mortgage on it is clearly a very valuable customer because their ability to pay is going to be higher than a customer that has 10 county court judgments, is bordering on insolvency. So all of these things help us to paint the picture of our customer, and all of those things in the round. So the bureau information, the information that the creditor will give us on that customer journey and their contact strategies, their approach to the collections within the lender, all of those things help us to build the profile of the customer and how we will collect it. So what strategies we will use. And things like age is important because if somebody is 21 or 75, obviously their income ability is very different. So that's why age is also important. Gender, location, balance, and credit quality. And the segmentation is important in terms of predicting how they will behave in the collection strategy.
You know, I'm going to also, ask Tamás this similar question when it comes to the segmentation, right? So, if at a very broad level, if I think about the way Karen characterized it is, the ability to pay. She also touched upon some things like a willingness to pay, right? So, do you see from a willingness to pay point of view, there are any ways that you want to segment, and if there is a way to segment customers, and then, because then that will impact the kind of strategy that a lender would use?
Well, definitely. So, the willingness of pay is, at least in my view, is even more important than the capability. Because if the customer is willing to pay, we will always find a way to find a reasonable agreement and settle it. If the customer is not willing to pay, then definitely. So this is a very strong sign, if we understand this, that we have to completely change methods. Because if there is no willingness on the customer side, it means there is not too much reason to keep the customer longer term as a customer, because there is a very strong conflict. So we have to follow simply different strategies with customers who are not even willing to pay. Because many customers, especially now when the economic circumstances change that rapidly, the banks in their portfolio will keep many customers who are willing to pay. From this perspective, they are completely healthy customers. But because of the change of circumstances, they are not able to pay back the same way as they were expecting. Then we find a way how to manage it. There are many, many ways from a collection perspective, from a system perspective.
Understood.
But if there is no willingness, that's a completely other story.
I'd agree with that completely, Tamás. I categorize these customers as the can't pays and won't pays. And there's a very different distinction between the way that they behave. And whether it's a consumer or a business customer also matters, because there's a lot more volatility in a business debtor's income than there is in a consumer income, where it's a base salary that they're earning, and therefore they're very homogenous. The characteristics are very similar, and they can perhaps agree a very low yielding payment plan, and they're very sticky. They'll stick to that plan. Not much will disrupt their payment plan unless they lose their job. But an SME debt customer is completely different. For them, credit management and collections is time consuming and distracts them from the business of running their business. It irritates them. And they'll engage with you when they're ready to engage with you, because cash flow is important to them. And they will pay. Usually they need some pushing, because they can be robbing Peter to pay Paul. It's an expression that we use here. Is, they're entrepreneurial in spirit, and they will push against payment in many cases. And the different strategies that you use and the different contact points are very important for the different types of customer.
Very interesting. I love the way you say it, can't pay and won't pay. Okay, before I get into the next question, I'm going to run a question for the audience. I have the second poll question coming up for the audience. When you are doing, designing the debt collection process, what is the biggest challenge faced when it comes to debt collection process? One, ensuring that the borrowers pay on time. Second, getting most updated information about each of the borrowers. Keeping in regular contact with the borrowers. Again, something that maybe technology will help. And of course, regulations. These are times when the regulators are being very, very quick about making sure that the customers are treated fairly, and making sure that lenders keep up with the latest regulations, know what's the impact of the regulation becomes very important. So again, I think there is a pretty much close tie between ensuring that borrowers pay on time and getting the most updated information about each borrower. So again, the basic is always about making sure people pay on time. So I'm going to end the poll and quickly share the results. So the most important factor is ensuring that borrowers pay on time. I think regardless of anything else, as a debt collection process, that definitely makes a lot of sense. But then we spoke about data quite extensively today, and that really comes up second. So I think we're on the right track. I'm going to keep on the right track and bring Ahmed. I'm going to bring you in and ask you about two things, right? One is, firstly, do you see customer becoming customer-centric when it comes to debt collection? How important is it? Maybe, from your experience at the bank, and then, how can lenders and banks, how can they personalize their collection strategy? What are some of the things that you see in your experience at your bank?
So if I take the first question, first thing, how important is the customer? Before we go into the customer service, how the customer is important in debt collection. First thing we need to keep in mind that we need to protect our customer base. Today in this competitive market, it's more challenging than ever to acquire or to even keep the new customers. This customer is a potential for future business, so we need to keep this customer. Also, we need to protect our reputation. That's definitely as caring and active part of the society we are living at. This customer is part of the economy, and we are not living alone. Financial sector is completely tied to the economy performance. So it's not of anyone's interest to get companies or individuals bankrupted or out of business. It's a win-win situation. So protecting the customer, trying to help him reschedule or restructure his debt is something that of an interest to any bank or financial institution. How customer service and the customer centricity important in debt collection? Definitely excellent customer service means going beyond meeting your customers' basic needs, better understanding of each customer's situation and personal situation, and more accurate mediation actions that can be taken if, as Karen said, his customers won't pay or customers cannot pay. How to understand, how to know, certainly, and take actions accordingly. One very important example I have seen is the self-service option some banks and European banks providing to their customers, offering them the ability to reach settlements and provide explanations for delay in a completely private and self-directed fashion without even a human involvement. Very confidential, and it respects the customer, and it keeps it's encouraging that customer actually to behave by himself, and definitely would reduce the non-working debt ratios. All that can increase the efficiency of the debt collection process with better collections and less difference. In regards to personalizing the collection strategy, again, this is I'm gonna answer these questions from my experience as an IT person. But that collection activity is the last activity in the lending process itself. Right decision in granting the loan is the key for collecting the debt later on. So we always, and the banks, I believe, always reads the data at the beginning of the lending process for credit risk scoring. And they never read it again, as I know, unless the customer fails to pay the due amount on time. We normally segment the customer based on demographics, location, income, industry, credit scoring. However, these are static data that can change over time, and it is missing the day-to-day customer's behavior What banks need to do to personalize their collection strategy is again to leverage on the internal, external, and online data, understand the actual day-to-day behavior of the customer and the market trends, so to enhance the prediction results, and again, the mediation actions. They also need technology, all that can actually only be achieved by technology and data and utilization of artificial intelligence and machine learning to achieve nearly real-time data aggregation to enhance business insights and improve the accuracy of prediction. By the end, what we are looking for, banks, all the banks and financial institutions need to proactively have micro-targeted marketing initiatives designed to offer their customers and their individuals and companies better micro-segmentation based on customers' dynamic behavior. And I mean micro-segmentation because it allows better decision-making process that can prevent the defaults on future payments. Provide early warning through dynamic models to take proactive and preventive measures. Technology really can help us not only proactively and even in reactive manner by avoiding the one-size-fits-all communication strategies and models they are using for collecting process. Having optimized and more customer-oriented communication strategy is a key. Banks need to provide their customers with mediation recommendation. All that can be done again by having trained agents and trained call center, qualified, experienced in dealing with customers to provide the appropriate level of care. I don't know if I answered your question.
You did, and I think I also saw Tamás nodding along. Tamás, is there anything that you would, I know for sure that when Ahmed spoke about the self-service, you definitely something that very close to you. That's what I realized now. But then again, I also want to ask you about how the technology is making this cost effective, right? While by definition, micro-segmenting, hyper-personalization, all this is important. Everyone would know that just from a very logical perspective, but it may not always be cost effective. You may end up spending more money in hyper-personalizing communications than the amount of recovery that you get through, right? So technology becomes extremely important in making this economically viable. So, if you could just throw light on how technology is making all this come across in an economical manner, that would be really great.
Yes, well, actually, it is not a surprise that many years ago, we were already talking about hyper-personalization, but this was for large volume transactions, so high net worth individuals, large corporates, and definitely not for the mass SME and retail business, simply because personalization at that stage of technology was very expensive. And the reason why today hyper-personalization is there on basically any mass market is simply because technology now gave us the tools to manage it not only properly, but cost effectively. Because now outreach, communication, finding the right method, these are all automated. Now we collect the data, we can apply machine learning algorithms to find the best way, what is the best channel, what is the best strategy, how to reach various types of customers, what are the personalized messages we want to reach out. Even self-service, what Ahmed mentioned. Yes, I truly believe in self-service that is now allowed by the newest technologies simply because, in my view, customer reaching out to the bank, customer willingly, on his own intent, giving a payment promise has a much stronger value than the bank reaching out to the customer, that dear customer, you are already late, please pay. That's a completely different dynamic. Customer coming to us has in itself a strong meaning. And experience shows us in Europe, in Asia, that payment promises given through the self-service channel have a much higher rate of fulfillment. So this is all what technology brought us. And of course, technology does not solve everything, because technology gives us the capabilities that we have to use in our process, in our strategy setting, in our approach to the customers. But it gives many, many capabilities now for reaching out to retail customers, to micro companies that we didn't have even 5 years ago. That's a fundamental change, in my view. And that's why collection departments, collection strategies have to change. And it doesn't mean we will do automation that we did not do yesterday. Because automation of the existing way of collections will bring us some cost efficiencies, but it will not solve the real challenge, because the real challenge is how to change the way of collections, how we do it completely differently, not only more cost effectively, but much more customer-centric and much more focused and personalized. And this is what technology allows us now to do.
This is very interesting. If I were to say this, the data statistic that you spoke about, that people are much more likely to pay if they come up and promise to pay and promise to restructure on their own. So the self-service becomes so important, otherwise, which is not, it's something that, is not very intuitive in that sense. I know we are getting closer and closer to the 60-minute mark, but I do want to, bring you in and ask, when it comes to technology, and we spoke about how technology is helpful. We spoke about data and how that brought up a small point, and I want to just expand on that if you can, about the agents in terms of how do you train them, making sure that the communication strategy that you have for the micro segments is different. How do you train them? How do you make sure that they know what type of communication strategy to use?
It's a very good question. It's important, and I agree wholeheartedly with Tamás, to have a personalized approach to the customer. And I think that the segmentation of a consumer customer data to a business customer data is very different. So in a consumer landscape, it can be much more call center based, whereas in a business debt collection, it's much more case managed based. Because as we said, there's volatility with a business debt, there's more homogeneity with a consumer debt. But to answer your question directly, how do we manage that process with our teams? We use technology, as Tamás and Adam said, to take out the routine elements of the process. So things like the credit control process, the sales ledger management, the bespoke lettering can be designed to different products and different types of debt and different strategies. And that can be fairly automated with a good case management system, with a good debt collection system. What you need is that when the customer does engage and does choose to come in and to speak to somebody, that the staff can then use that time meaningfully. So the case management system takes the routine elements away, but where there is customer engagement and discussion, that is more bespoke and feels like a more personalized journey, as Tamás said. I mean, in terms of training staff, because we have a law firm, our own law firm that manages the assets that we buy, we tend to recruit graduates, so law graduates or people from industry within credit control. And you have to have an interest in collections. You have to have a passion for collecting money. If you don't have that passion, then it isn't necessarily going to be the job for you, because it's fairly relentless. It's a relentless process of making contact with customers, and it's essentially a sales job, selling to them that it's better for them to pay this debt or come into an arrangement or reach a settlement than it is not to do that. So we have different training techniques that will be around what good call handling looks like, what good engagement with a customer is, how to use the data that we have centralized, and to use that in the tactics and the negotiation with customers. And that's the bit that can make the job interesting for people that work with us. And there has to be a real buzz in the office about the collections and getting that money in. And I think any credit manager who's on the call, who's managing a big team, will get that, will understand what I've said, because there is a passion and a drive to get the collections in for the business. But managing the team on a high level basis is about different workflow strategies, different call campaigns, different initiatives regarding settlements, different approaches depending on the segmentation of the debt. So, a £500,000 debt that is owned by a company with 5 personal guarantors from directors and debentures is a very different complex collection strategy to the student loan that is a £4,000 loan, is going to pay £5 a month. But that's what makes collections interesting, by tailoring it to the different type of customers that you have in your portfolio.
Sounds, Karen, you almost sound like saying that, look, technology can make the life easier, but look, this is something that you really have to be passionate about, and it's not going to go away. So, with that, I think, the whole point about automation, the whole point about personalizing, the whole point about data and technology, I think is making the life of a collections agent simpler and complex, maybe at the same time. And I think overall, again, I think from a point of view of what we set out to achieve in this webinar is, again, to emphasize the importance of customer centricity when it comes to debt collections. I think from all the discussion here, I am very confident that our audience is able to take away that, look, customer centricity is definitely something that you need to think about right from the start when it comes to debt collections. I can also see that there are a lot of takeaways, at least definitely for me, that there are differences when it comes to the customer side, the retail side, and also from the corporate side. Very interesting, for me, definitely the high point was how Tamás, you mentioned about the self-service technology, something very important. And Ahmed, I think overall, just from a point of view of how things are changing, I think you set up the whole webinar beautifully by really talking about the economic difficulties, the regulatory changes, and how data and technology, is impacting. So I think we've managed to cover a lot of ground here. I know we are slightly over time here, and thank you so much. I can see that, we have most of our participants still on. So thank you so much, everyone, for being on the call. And, I would like to thank my panelists for all the time and for their insights that they have given us on the webinar today.